their clients were actually drawing down. They actually flipped the switch from net inflows of non-interest bearing money to now withdrawals. Now it's going the wrong direction.
Yep.
Which means their free money is disintegrating, the needs of their clients are rising, and all their assets are tied up in long-term treasuries.
Yeah, they're underwater.
So what did they need to do? They need to raise liquid funds, and the only way they could do it was to liquidate their long-term treasury position, which
And
they did
or
to
raise
the
money.
tune of a $1.8 billion loss,
Yeah.
and then tried to raise money at the same time. And anybody looking at this picture from the outside is gonna go, holy shit, you're screwed. What's up, everyone? It's been a minute, but we are back with a fresh episode of Hot Talk. It is raining outside, so we have our honorary open flame sitting right here. And today's topic is the Silicon Valley Bank failure and the FDIC takeover. This is quite honestly ridiculous.
There is so much going on this week. I mean, we have Silicon Valley Bank, don't forget there's Silvergate. And this is after everything we've already gone through this year with FTX, just tech in general, interest rates going up. There's, is it going to stop?
So this has been really interesting for me. In the latest shoe review that I made, I talked about the first time that Silicon Valley Bank really hit my radar. I am heavily invested in kind of high-risk innovation, biotech being a staple. And a company that I have tracked for due diligence, AvroBio, had a gene therapy for Fabry disease. And quite frankly, I didn't see it actually being viable because it required a chemotherapy conditioning treatment versus competitors, which were just using IV injected AAV. They needed a cash infusion. They went to Silicon Valley Bank, and Silicon Valley Bank extended them $65 million at 8% interest. This is a clinical stage biotech in a phase 1-2 as their lead asset. When I looked at this, I basically said to myself, what bank authorized this underwriting? There is no way in hell that this company is ever going to make good on this loan. And the problem is in this space, it's completely unnecessary because the bank could have just issued shares.
Yep.
The only reason you make a step like this is because you internally think, oh, your shares are going to be worth more when the clinical asset progresses, so you're trying to ease the pain. It's an unnecessary optimization. And when I saw this, I said, Silicon Valley Bank, that ain't no good. Well, you know, fast forward 2 years and I see the news of the failure and I immediately think back to the underwriting and I'm going, what went wrong? Now, the reality is I've done a lot of digging between yesterday and today, and I would say it wasn't actually the underwriting that caused the failure, but in trying to get at the heart of the failure, it wasn't obvious. And I think a lot of people are pointing fingers in different directions, so I really want to have a discussion around kind of all of it to set the kind of picture though for people who might be watching this cold. I mean, I don't know if you have any background or if you want to talk to it or if you want me to just keep going here.
No, so I think for me, this whole ordeal, as you're aware, kind of looking at Q4 last year, Q1 this year, I've started transitioning from music more into this finance space. So luckily, SVB doesn't impact me or anything I'm touching, fingers crossed. I did get a bunch of emails, but I think I'm okay. But that being said, what happens here in finance, we're in the Bay Area, what happens in tech, I'm looking at the ripple effects here, and that's actually everything going through my mind.
Right. So the initial articles about this pointed at a loss on a sale of treasury assets that they held as the primary driver for the failure and the ultimate bank run. And the run on the bank is an interesting aspect of this because it actually is heavily psychological, and if, you know, everything
yeah.
we talk about on this channel, everything in this world is driven by psychology. I sent you some notes on this, and at a high level, you have to look at the composure or the makeup of the clientele of this bank. It is very wealthy, very shrewd individuals who, quite frankly, from a business perspective, are going to be ruthless. If you let them think for a second that their assets are at risk, the first thing they're going to do is yank them.
Yep.
And I read an article today from people that work at RA Capital, and it was trying to encourage the industry to not make a run on the bank. And in the very article, they acknowledged the benefit to those who make the run on the bank the first.
Yep.
And I'm thinking to myself, this is the reality of this world that you live in. This is the reality of that clientele. To blame the consumers or the clients of the bank for the ultimate bank failure, in my opinion, is placing the blame in the wrong area. Because you have to, under the conditions, make sure your balance sheet is unassailable at all times, or your clients will cut your throat.
It's the same way in every business. If we need money, we go to the bank. They're not loaning us money at our best interest. If it makes sense for them, they're going to loan it. When the situations are reversed, in a very, very rare case such as this, yes, that happens. And here's the reality. In finance, it's a bunch of vultures.
Right.
And then that's it. VC, same way. Finance, banking, it's absolutely no different. And it's really interesting because I've been learning a lot about the difference between VCs and private equities and getting into the tactics and understanding the levers that are pulled. And you're like, oh wow, this really, like to your point, this really is cutthroat. So I read an article today that said 110 venture capital firms all signed to back Silicon Valley Bank and says, don't let it go under. And yet, I think it was on Friday, it was Founders Fund. I forgot which one was the other one I read, but they said, hey, we recommend everybody pulling their money out. So the same people backing it or the same people doing it. It's just a matter of, to your point, there was a time frame in the beginning where it was advantageous to get your money out. And then it sprouted. It's like, okay, now you made out. Everyone else did it.
Right.
You did.
So you have the interesting thing about the makeup of this, and quite frankly, I'll circle back to this once I explain, I think, the technical mechanisms through which this bank ultimately failed. But you have a concentrated position, right? Like if you compare this to other banks, let's say Bank of America, JP Morgan, right?
Yep.
You're spreading out the deposits and risk across a much larger swath of people.
Yep.
From different classes. You would need a kind of next level event to cause a run on the bank at scale, right? But here, the wealth is concentrated in, comparatively speaking, a handful of people. And I'm making assumptions about the size and how ruthless they are, but it's validated by the reality, which was in a single day, they experienced north of $40 billion of requests for withdrawals.
Yep.
Which is
roughly 33% of their deposits on hand.
Right. Which is insane. So I think people who are pointing at the run on the bank as the cause for the failure are actually looking in the wrong place, because the run on the bank exacerbated the problem, but there has to be a trigger to start the run on the bank. There has to be something that creates fear that the money is not going to be available, that forces people's hand. And I think I've uncovered what that is, and I want to talk.
Well, I think mine's different, so I want to hear this.
Okay, well, so I'll get to that just after this. Okay. I did watch a video, and this video I believe had merit, but I believe it was laying the blame at the wrong place, directly anyway.
Okay.
It claimed that the Fed raising interest rates is the sole reason for this ultimate bank failure. And this is interesting to me because I do believe the Fed holds a certain degree of responsibility. When I think of government, I think government needs to be slow. I think they need to understand that everything they do is very far-reaching. 300 million people in the United States, all of them are affected by interest rates. You raise the rate, how much did they raise it? 4% or something in the span of a year? I mean, that's actually kind of insane.
Government needs to provide stability, and by stability, it has to be for the long term, over 10 years. 4% in 1 year, it's gambling.
Right. And so I have a HELOC on my house. A year ago, I was paying a certain amount. Today, I'm paying more than double that. But I knew what I was signing up for when I took on the loan,
Yep.
and I better be able to make the payment because the government is not going to bail out my HELOC.
So take that example. It's the same situation with the bank. The bank made some bad investments, let's say in treasury bonds at 1%. Who knows? I don't know the number. Now we know rates are at 6-7%, so they're down on those bonds. They're stuck unless they see it mature. Taking that same analogy as your HELOC, with interest rates going up, the question then becomes A, self-assessment, are you liquid? What do you have coming up? You know, it's strategy, tactics, action. Silicon Valley Bank, I think their egos were so big. That's my opinion now. Egos were so big, they chose to sit still. If I were them, I would have been either selling shares a long time ago. I mean, it was a series of tactical errors.
Yeah.
But
So you're touching on it, and the best article I found about this that really identifies the true root cause of this was written by a short seller. And
Okay.
short sellers are great sources of information because they identify these issues well in advance. And this guy said that he saw this smoking gun well over a year ago. What basically was happening is money was cheap, right? COVID money, 2021, money was cheap. So the bank, I got the numbers here. I want to get them generally accurate. So let me just make sure. The bank in 2020 had 67 billion in non-interest bearing deposits. Okay? In 2021,
Is this SVB?
This is SVB.
Okay.
In 2021, that rose to 126 billion.
Right.
So in the span of a year, they more than doubled or close to doubled their non-interest bearing deposits. Now, their SVB, they're sitting on $100 billion interest free.
Yep.
And they're looking at it and they're going, well, what should we do with this? How can we make some money off this? And you know what they did? They took their long-term securities portfolio, which is basically treasuries at the time, because the interest rates were damn near nothing,
Yep.
very low yield, and they increased their position from 17 billion to, get this, $98 billion.
Wait, at 1%?
It doesn't matter what the percent is.
Kinda does.
The true problem here, the real,
Yeah.
I mean, yes, basically dirt cheap, right?
Right.
Like when, about as low as you're ever gonna see, because the cost of money was negligible.
Yeah.
The big problem here though, and this is the smoking gun, and when I look at this, I'm like, holy crap. I mean, it just screams off the balance sheet. 17 billion to 98 billion in long-term securities, meaning, to your point, they've now taken what used to be liquid money and they've made it illiquid.
Yep.
In an environment where they should have anticipated interest rates were going to rise. Everybody knew that. There was only one direction it could go.
Yeah.
So, what has happened since is the macroeconomic picture deteriorated, right? And who's going to get hit the hardest when the macroeconomic conditions deteriorate? Their clients, VCs, startups, people who aren't making money that rely on cheap money, right? It's like you should just know when you fall on hard times, your clientele is going to need you.
Yep.
And you went and tied up, I would say, the majority of your liquid
67%,
assets.
yeah.
And so what happened is their treasuries basically became worth 70 cents on the dollar.
Yep.
And you could argue there's an element of this that factors in where the cost of money rises. So their clients were actually drawing down. They actually flipped the switch from net inflows of non-interest bearing money to now withdrawals. Now it's going the wrong direction.
Yep.
Which means their free money is disintegrating. The needs of their clients are rising. and all their assets are tied up in long-term treasuries.
Yeah, they're underwater.
So what did they need to do? They need to raise liquid funds, and the only way they could do it was to liquidate their long-term treasury position, which
And
they
or
did to
raise
the
money.
tune of a $1.8 billion loss,
Yeah.
and then tried to raise money at the same time. And anybody looking at this picture from the outside is gonna go, holy shit, you're screwed.
Well, yes, okay, 100% agree. To add on to that, they made that PR announcement on the same day Silvergate happened.
Right.
Why? like, wait a week, wait a day. I think there's two elements to this. You approach this very much, and this is where our dynamic works well. Everything you mentioned is actually black and white. It's in your face. It was in plain sight, right? When I look at things, I'm looking at things from, because we're constantly in growth. So, you know, for the audience, let's not beat around the bush. Everything I'm touching, we're trying to figure out what to do right now because interest rates are high. Growth is down. VC, we fundraised a venture fund when we look year over year, VC funding is 62% of 2022, much less, and even lower from 2021. So how we're able to do it, just fingers crossed, knock on wood, thank goodness we are. But I keep looking at that from the psychology point of view and what decisions are they making to even do that, because I think that'll help the audience. But yeah, listen to Brian. Everything he said is in plain sight, that's just crazy.
So it made them an easy target for sophisticated short sellers,
Yeah.
which, I mean, you know, quite honestly, in the spaces that I operate, you have to expect that. So much of stuff that I've invested in over the years has been the target of short sellers. I mean, you know, claim to fame, $30,000 check on the wall, fundamental storyline of the television show Billions, Elan, Sac Capital, short selling, you know, insider trading scandal. So I'm used to it. Nothing surprises me anymore. And yes, you know, a bank, an institution of that size, you might think they're not vulnerable to such an attack, but when they make a decision like this, man, I mean, it's sad. It came back to bite them in a really, really terrible way, very, very quickly. And you're right, you know, I've kind of put the Legos together to build the greater story and try to actually crack what really took place here. But initially, my gut feel was they lended to an industry that was susceptible to macroeconomic conditions.
Yep.
They concentrated wealth in the hands of a few who are ruthless. And as conditions deteriorate, those people are going to be first in line to make the exit. And you know, it's a simple story to paint, and I immediately thought that, but I really wanted to see how all the pieces connected in the end.
This is the way I kind of look at this story. Like if this were to become a movie, we've all seen the movie before. You have one guy, the gangsters look all pretty, they look like a lot of fun. You want to do business with gangsters, and then you get mad when they act like gangsters. That's what happened here with SVB.
There's an element of this that also I find kind of ironic, and Silvergate was crypto, but you know, if you kind of think about it at a high level, there's this dynamic of like crypto and the Web3 space versus, you know, the institutionalized banks, and it's kind of like one or the other and they're at odds. And the institutionalized banks had their day in the sun as, you know, Web3 kind of fell apart and Bitcoin deteriorated. If you look at what just happened here, I believe there's a strong case to be made for having your money in a cryptocurrency that is math-based, decentralized, no man in the middle, that can make dumb decisions and F up, you know, what you have in your bank account that's accessible by you.
I mean, let's look at it, right? And we're not giving any financial advice, so just call that out. But you identified that Silicon Valley Bank had the money in the hands of a few. So making it decentralized, putting it in where if there is a token out there, and I'm just not saying names on purpose, that is in so many hands now that one person potentially can't ruin it. It's like, it kind of does make sense. And then when you look at it on a global scale, right? So I'm raising my money in the UAE right now. Here's what I do know. Europe, they're not doing so well. We're not doing so much better. Our dollar's super strong though. Asia, still trying to come out of COVID. It's like, what is going to happen? Web3, that's more technology. Crypto looks more and more attractive. That's just at least in my book.
So, yeah, it is interesting. And I was thinking about this, and part of the problem I see is you've got kind of interests on both sides that don't necessarily address perhaps a common actual consumer need. So I'll give you an example, right? Bitcoin, I think it has proven that it's stable. It has its own kind of inherent risks that could potentially undermine it if you think about like, what's the right word? This quantum computing, right?
Okay, yeah.
If you develop computers that are fast enough to crack the encryption, then it could be worthless overnight. That's always a inherent risk to this.
Yeah.
Bitcoin, in terms of volatility, from 20,000 to 70,000 is kind of, you know, I don't know if I can park my money there and get back what I put in, but I will say Bitcoin at 20,000 feels like a pretty safe place to park money.
Yep.
In an ideal world, not tethered cryptocurrency, if I could legitimately, you know, put my money, US dollars, into something where I know the US dollars I put in, you know, maybe there's a moderate or modest interest that's accruing, so it's not just sitting there idle. But if I could put it in and guarantee that at some point in the future, I will definitely be able to get it back out, so that I'm not worried about a bank going under.
Yep.
That's very attractive to me.
You know, it's so funny. Let's take this back like decades, right? I don't want to take it back too much further. Clearly, we're Asian. You know, I remember growing up, San Francisco. You walk into Chinatown, it's a known fact. Everybody's grandmother lives in this one building called the Ping. Everybody's flush with cash and or gold, right? At my wedding, we get, for those who don't know, when you get married, everything is 24 karat gold. There's just jewelry everywhere. When we left the wedding, we took all the jewelry, put it into 3 bakery boxes, and had guests walk it out, because Asian weddings are known to get robbed, because that's where we hold it. So it's, if we think about it back decades, just kind of going culturally, Asians never believed in banks. That's why there was Chinatown, and it had its own ecosystem, if you will. Growing up, hands down, it was gold, Rolexes, and cars. That's how I knew to save money. That was liquid. If anything happened, you knew you can go do that. You could transport it, etc. We didn't deal in banks. So this, but it's, so banks, I mean, 1920 happened, FDIC was created, great, it does work, it makes it all international. But again, let's not beat around the bush. They are for-profit companies. So when we're talking about assets here.
Right, there are worse things to spend money on.
Yeah.
I like that list.
No, that's it. I mean, let's look at it. These here, have they gone down? We both have our watch collections where we're doing okay. Like, you may not get the growth, but you'll definitely get the stability, right? So,
I use it as an excuse to buy a lot of things that I just like. I really have no intention of ever selling any of the stuff that I buy. But you're right, it is worth something, and if you need to move it just for whatever reason.
Yeah, no, in this regard, and just so you guys know we're not getting off topic here, I think we've mentioned this before, it's all about a balance sheet. If you have cash in a bank, it's on your personal balance sheet. If you have it in shoes that you know you can sell, it's on the balance sheet. Where you store your assets, that's a personal decision that'll give you growth, stability, safety, or whatever. But then kind of getting back to it, I really want to touch on like what happens from here.
Oh yeah,
right?
We absolutely should. And I guess one thing I just want to say to kind of touch on that point though is like, at the end of the day, we're all responsible for our own decisions.
Yep.
And it's, you know, a question of how much risk versus reward do you want to assume. And what really sucks here is, if you know the way I'm positioned, all of my discretionary money is in stuff that I believe can 10x, 100x, but quite frankly,
go to zero.
I expect and understand it can absolutely go to zero.
Yes.
And I'm okay with that because everything else is taken care of.
Yeah.
When you have someone in the middle, in this case, the people who are managing this bank, either foolishly trying to optimize to make an extra dollar, or just being completely unaware of the risk that they were assuming, capable of making a decision that undermines you, unbeknownst to you, when you had your money in a bank that you thought was safe. I mean, that's just terrible.
Yes.
And that gets at why, crypto that's math-based with no one in the middle actually does become an attractive proposition.
Yeah.
So where do we go from here with this?
So let's look at it from a few different ways. From an investing point of view, I'm personally starting to see a trend where people try to go direct. There's, for those who don't know, you can invest money in a fund, you can buy stocks. There's these things called SPVs, which are essentially just ways to go direct via a middleman, or a special purpose vehicle is what they're called, to invest. You see those coming up, which is super interesting because the LPs are essentially the GPs of the SPV, except someone else is managing it, but they still make all the decisions. So it's like you make your own fund and you have somebody work. There's a lot of that happening in finance. When we look at tech right now, I don't think it's a bad thing necessarily. I think there's going to be a resurgence in fundamentals. A lot of the hype, marketing, and growth will slow. That's not necessarily a bad thing as long as there is growth. We talked about stability. You get high growth, it'll cut off just as fast, right? We all know that with stocks, runs up or down. The biggest thing that I see there, just on the growth aspect, it's going to weed out a lot of people. So just touching on crypto, I met a few companies this week, won't give any names out, very, very fortunate to have fundraised in crypto. Let's say Q2, early Q3 last year. Good for them. I'm listening to their business models now and I'm like, very much, I hope you're pivoting. I hope you're adjusting.
Right.
Right. So it's forcing people to grow up.
Right. Oh yeah, no, the biotech sector has actually realized this, I would say, a year ahead of everyone else.
Yep.
I think in the last Hot Talk I had mentioned it, valuations, indexes, I mean, everything is the lowest it has been, I think historically even, and unfortunately it compounds upon itself, right?
Yep.
So in a sector that requires on fundraising to stay afloat, if the conditions have deteriorated, they just continue to get worse. Mm-hmm. I think that actually is kind of a risk for the venture capital area here. One thing that I've heard kind of referenced is what happens to the valuations of the companies that are on the books of these VCs under these circumstances.
Yep. So I shared with you the liquidation list from FTX, right? So just take that into account. Let's use public information. 50 million investment from FTX into Sequoia Holdings. They paid 90%, right? 90 cents on the dollar to buy it. I think the bankruptcy judge still needs to approve it, but someone put an offer for 45 million, and for what was 50 million, and you assume it's already gone up. The valuation that I saw was much higher than 50 million, and they got it 90 cents on the dollar. There's other things on the balance sheet where I believe we can get 10 cents on the dollar, 20 cents on the dollar. There's companies on there that are Google backed, right? We just talked Sequoia, that one's public. There's a whole bunch there. So if those are already pennies on the dollar and they're getting approved, that just tells you on the open market, it's actually just as bad. From my vantage point, this is where I think the fun begins, and it really depends on everybody's access. So we have our access in the Bay Area, mostly in LA. So I'm seeing deal flow come across our table constantly. And this is, to me, this is where the fun begins, because you can actually see who's doing what. So it's like, let's not be stupid like SVP or Silicon Valley Bank did and kind of go nuts, but there is money to be made in recessions. Like this is
100%.
This is where it's time to have fun.
So
don't be stupid about it, but have fun.
This is no, I completely agree. I mean, I've always said you don't actually make money in the good times. You make money in the bad times. When everybody is running away from everything, if you understand fundamentals, invest for fundamentals with discretionary money that you don't need liquidity on, you can make out like a bandit.
Yep. And on the flip side to that, if you're operating a company and it's in a recession, this is a time to start planning your exits, because all of your larger competitors or would-be buyouts, roll-ups, however you want to call it, when the economy turns and they start growing again, everybody grows by acquisition. So what is a problem you can solve for them when the economy turns? That's the advice that I'm giving every company I'm touching, and that's what we're planning for across the board.
So I think we actually nailed this one pretty good. We didn't go on too many tangents.
No, I want to so bad.
I do want to close talking just about what happens to Silicon Valley Bank from here specifically, but was there anything else you wanted to hit on before we do that?
No, it's just nice to be back. It's been a minute, as not everybody knows, but I've been traveling. We're in the Bay Area now. It's raining. I think I've been home 2.5 weeks this year, between Dubai, Nashville, LA, and just everywhere else around. It's it's definitely nice to be back, catch up, chat. Wish that we're on better circumstances. I know we actually have more hot talks ready, because I know I've been gearing up content that I'm like, we just need to find time to hang out.
Right. Well, I'm really glad you were able to carve out some time tonight. And shout out to Henry, who actually said we need to do this. And I had wanted to do it, but like he made sure that this happened. So this is for you, Henry. In terms of what happens from here, the big question of the day is, will depositors be made whole? And it's funny because, on the kind of outskirts but living in Silicon Valley and invested in, biotech, other innovative companies, I thought my exposure at the start to Silicon Valley was zero because I don't bank with them. Turns out 8Ks start to get filed in the afternoon on Friday, and everyone reveals how much they had deposited with Silicon Valley Bank. And sure enough, companies that I've invested in have money tied up with Silicon Valley Bank. An example that everyone I think will understand is Roku had 26% or over $400 million. 500.
1.9 billion is what they have cash available, so 26% of that,
Anyway, so I don't know why I might have messed up the 26%. I thought it was 400 something, but regardless, they got a lot of money tied up with Silicon Valley Bank, and that money is for operating expenses, right? So we're talking about companies' payroll, ability to pay the lease, keeping the lights on, and this impacts a lot of Silicon Valley. A lot of people out there are wondering, am I gonna get my next paycheck? Am I gonna be able to pay my credit card and my mortgage? And so the question becomes, how quickly can this get resolved? Now, I'm impressed, really impressed, unfortunately for Silicon Valley Bank shareholders who had their stock at $300 not that long ago, are probably going to honestly end up with nothing because the FDIC came in and equity gets paid out last. I just don't see it happening. But I think they stepped in quickly enough that the run on the bank couldn't actually happen. And there are assets there to distribute to make depositors whole. I hope that happens. There's discussion about the FDIC wanting to sell this bank to a larger bank, hopefully by Monday. I don't know how realistic that is.
It's not going to be Monday, but that's the option. That's the best option for everybody. It gets bought by a bigger bank. The bigger bank has the funds to make everybody whole while the transaction happens. If it waits for the FDIC and let's say the bank actually turns over, I mean, for those of you that have gone through probate, it's no different. That's going to be my guess, and that's not fun nor good, and it's expensive.
So, and I agree, and the reason that a big bank would probably want to actually do this, where I actually think there's going to be a competitive process to this, because if you're a bank with, let's say, trillions in assets, like I think JP Morgan has like 3 trillion, you can absorb 200 billion and the fluctuations that come with that.
Yep.
In return, you're getting access to all of Silicon Valley venture capital.
Yeah,
there's value in
and
that.
it's actually, the number's actually quite low, right? Because they were raising 2.25 billion for a third of the company. So you put the whole company at a valuation of 6.5.
Yeah, I mean,
6.75,
well,
right? Like,
yeah,
in theory, right? And now that everything's kind of lower, so I mean, if you get $1 trillion banker, I mean, look up the valuation for any of the top 3. They can easily gobble it up just for.
You're right from the actual cost, which again I think is going to be negligible. It's more just about willing to assume the risk and take over the operations. In return for that, they're going to get access that will be very positive for them on the next upswing.
Yep. See, and actually just to kind of touch, right? Everything's 2020 in hindsight. Let's say Silicon Valley Bank didn't sell off early their positions in those treasury bonds, right? They don't have the 1.8 billion write-off. I get it, it's worth shit. Who knows how many more years they had left. Would they have had a better chance to raise from a larger bank? That's where I think it's ego, because they probably didn't want to lose control. That's why they didn't go to a larger bank, but it could have saved this whole process.
So the number that I read, and unfortunately this showed up on their balance sheet, and so outsiders can see it, which is why they became the target of a short attack, is they had basically on paper 15 billion in losses on their treasuries. Because
1.5.
Yeah, like they sold off 1.8 or they sold off I think a certain amount at a 1.8 billion dollar loss, but on paper they were sitting on a 15 billion dollar loss. And everyone could see it.
They were getting ready to sell more. They sold. That's crazy.
They had 97 billion tied up in long-term securities, which people were saying were actually selling at a punitive 70 cents on the dollar. Because here's the thing, if you wrote a loan at 2%, meaning you're getting back 2%, but someone else buys it and cost of money is 4%, they're going to take a discount because it costs them money to service that.
Yeah, so they're already writing it down. Oh, that's nuts. All right, more of the story.
The other thing about this that's kind of nuts is like the fact that, you know, corporations are using banks that are FDIC insured. It's like, as a consumer, you know, I can peanut butter spread money around so that I'm covered at the $250,000 cap.
At that level.
But you got banks that are putting in 400, 500 million, and they're insured for $250,000. You know, this is where it's kind of just like, you gotta, if you're running a business, you kind of gotta go with the heavy hitters at scale. You gotta make sure your money is safe. And
I know, and let's be honest, right? Like, that whole too big to fail, I don't think we're there. We heard First Republic was, their stock went down. Everybody was looking at them to see if they need to pull out. Seemingly they seem solid. I don't have diligence.
I thought about it and I was like, I don't keep any money in cash anyway, and I do have accounts at First Republic, but I'll be fine with the FDIC insurance. So I don't think this problem results in contagion. Unless, I mean, I think the Fed will have a big say to this. So first of all,
and does this put the Fed in check to slow down?
Oh, I think unfortunately it kind of has to. You know, they can stick to their guns, but it's going to be at the detriment of the banks. And the problem is, you know, short sellers have seen this work successfully. So if the Fed doesn't change their position, they're going to look at the next easiest target, and they're going to go from there.
No, that's very fair, very valid. It's gonna be super interesting.
So we're putting this out on a Saturday, and we're gonna have to see what happens to interest rates on Monday.
And we'll probably do a quick follow-up to this one, since we'll be back, or I'll be back in town soon. Let's see where this goes.
All right, well, I think this was a great one.
Yeah, I know we're not done yet, but we know that they're about to get back, and let's see where this plays out, because there's so many places we can take this. If somebody wants us to take this in a different direction, post it in the comments, because I'm trying my best right now not to go on a tangent, because we haven't caught up in a long time, so we can go forever here.
All right, we'll save it for the next one. All right, I think that's all we got.
Yep.
Thanks for watching. We appreciate you, and we will
see you at the next one
soon. Nice.